back. Part 2, let's get this done. Okay, so the next part of it is intrinsic value, right? All these parts right here, we have been measuring the business success, and it's time to actually value the company. What does intrinsic valuation mean? It means what is the true value of the business. And in finance, there are many different ways that you can do this. There's a comparables method, there is a discounted cash flow method, and then there's a dividend discount model. So those are the three major ways that you can do it. I personally find the DCF, which is the discounted cash flow model, to be one of the more accurate predictors, and I like using that as a good ballpark figure of what the stock price should be. This is not what the stock price will be trading at, but it's what the stock price of the company is actually intrinsically. Okay, so let's get to it. How do you actually do an intrinsic valuation? So the first thing you need is an intrinsic value calculator, and honestly I built my own one on Excel, but I also found this one that's really good from gurufocus.com, and I'm not promoting them in any way, but this is just something that I found on the internet that's really available for you guys. It uses some parameters, and I'll explain each one to you. All you have to do is put these parameters in, and it's going to throw you a value out. So how do you find these parameters, right? So earnings per share for Facebook, you want to know how much the earnings per share was for the entire year of 2019. And how do you get that? Well, you could just type Y charts in Google and type Facebook EPS, and you'll come to this chart right here, and the data for this range, you'll see the last 4 quarters are these numbers right here. If you add them all up, you will get 6.35, and I rounded it up to 6.435, and I rounded it up to 6.44. So that's how you get the EPS right here. And then the growth rate in the next 10 years, right? Because you want to, the DCFs are usually done for 10 years. You could also do a 5-year DCF, or you could do even a shorter duration, but looking at the long-term trajectory of the company is much better. So we do a 10-year discounted cash flow. And how do you get the growth rate? What you simply do is, I actually did this on my own. So I did a Excel for the growth. Okay, we know from Morningstar that the 3-year annualized rate is estimated to be revenues are growing at 36%, but I wanted to find the 10-year rate. So what I had to do was do my own analysis from all the data that I could get. So I took the revenues from 2014, 15, 16, 17, 18, all the way to where we are right now, and then I put it into an Excel sheet right here, and I calculated the growth rate by employing a formula. This minus this over that gives you the growth rate, and you do this for all of them, and those are the year periods. Now the mean, which is these numbers divided by the number of numbers, which is this plus this plus this plus this divided by 5, gives you 40. But 40% growth rate for a company in 10 years is not really realistic, and so I decided to half this rate because we are only looking at 5 years. So if we look at 10 years, I would expect the growth rate to half. So for that reason, I chose a growth rate of 20%. Okay, so this is a fair growth rate. I'm going way below what their actual growth rate is, and I'm kind of forecasting it into the future. Now DCF is not always very accurate because of the fact that the DCF valuation method has some assumptions that you have to make, and the assumptions that you make are dependent on what you put in. So what you put in here will give you the terminal value, and the terminal value is what you will be using to determine what the price should be. Okay, so the next thing you want to look at is the terminal growth rate, and what you can do for that is Google it, right? And if you Google it, the first thing that comes up is actually this on Finbox, which also is another good platform. So you don't need to get your information all from one place. I get them from different places and make sure that they make sense. The perpetuity growth rate, which is 4%, would be also similar to the terminal growth rate, and so we can use that as the terminal growth rate, which is, what is the growth rate at the inflation rate, right? So it has to be smaller than the discount rate so that you can calculate things properly. And then the years of terminal growth are going to be 10. Let's leave it at 10. And the discount rate, from here you can see a discount rate of 11 to 10, and I decided to take the lower band, which is 10. What is the discount rate? And the discount rate is a much bigger a bigger component of DCF, because the discount rate is essentially how much do you discount Facebook's future cash flows to the present, which means to say every year Facebook is going to make money, and for every year it's going to have expenses. In finance we call this the WACC, which is the weighted average cost of capital, WACC, and this is something that we use to find the discount rate. So the weighted average cost of capital is usually about 10%, and so this is a fair 10% value here. Now if you put all of these in, let's say you change this to 11, then you realize the DCF fair value changes. So you got to be careful on how you predict these, and if you do these right, then you come with a fair value of about 221, which makes sense, right? Facebook is trading around that value, and so Facebook is supposed to be $221 based on its earnings, but it is trading at 210, which means to say that it actually should be here, but it's trading here. So it's been sold off because of the earnings, right? So is this valid? That's the question. And is Facebook still a good investment? I think it is, and I think that it has significant upside. So that's the basic fundamental analysis, right? And then who are Facebook's competitors? We've gone through this. They are no competitors. And what does the 10K and the 10Q say? So there is a report that is filed every year called the 10K from Facebook. They have to file it with the SEC, and this is kind of what it looks like. And it has a lot of forward-looking statements. It's an official form with the Securities and Exchange Commission, which is SEC. And what are the important parts to read about this, right? I like to read about the risk factors. What are the significant headwinds that the company may face in the future, right? For example, let's just pick one here. This one's not that interesting. So our business is highly competitive. Competition presents an ongoing threat to the success of our business. So if you read this chunk here, you will realize what Facebook thinks is their competitor, and how they intend to address it, or what are the things that can cause Facebook's business to go down. As an investor, these are important things you need to know, right? What is the chink in armor, so to speak? So I would read these, because these are important things that the finance division wants you to know as a shareholder. And then as you go further down, they give you more financial data that you can validate, basically. But this is all the same numbers as in Morningstar. If you go correlate them, they will be exactly the same. And then on the bottom, you'll see additional financial data and stuff like that. The next thing is the management doing a good job? That you would have to be the judge of, and you would have to follow the company closely, right? So I've been following Facebook for a while now, and I think that this is a great company. I think that Mark Zuckerberg is doing a good job. He has handled the scandal pretty well last year. The company rebounded, but now has sold off because of a bad guidance. So do I think Facebook is a buy here? I think fundamentally it's undervalued, and I think that there is something to look at. So let's see very quickly, within less than 5 minutes, what the technicals look like, right? On the daily, the chart's looking on an uptrend. The moving averages are all stacked on top of each other, which is nice. And on the day after the earnings, there was a big amount of buying. We can confirm if that was actually buying or not. Let's see. So looking at, yeah, so this was actually not buying, this was selling. And we can see that Facebook has recovered since the earnings. It's actually on an upward trajectory here. And it's about to break out of this resistance. The red lines here you see are the resistance, and the green lines you see are the support. There was also some buying coming in that came in today actually. So this may be a good play in the short term. I can see an upside at least to somewhere to 220. That would be to close this gap right here. I definitely think that Facebook can go back up, but it might need some time. As we know, things never go up in a straight line like that. It is always going to be up, down, up, down, up, down, up. There's always a impulsive wave and a corrective wave, an impulsive wave, a corrective wave, impulsive wave, corrective wave. So yeah, I think exciting times lie ahead for this company, and I'm bullish. Thank you for watching this video. If you thought that it helped you out in any way, please leave a like on it. Don't forget to subscribe for the next one. And starting off in this next future videos, we will be covering technical analysis, where I'll be getting into what all these lines and candlesticks and indicators are. My charts are really simple. I keep things simple. So I'll see you guys next week. Ta-ta, till then.